Hi everybody and welcome to Amanda Loves to Audit, and today I wanted to talk about analytical procedures. And the reason I want to talk about analytical procedures is because they can be really useful in helping us identify things that could be inherent risks. So when we're thinking about at the planning stage, we're going to use those analytics to help us identify inherent risks and areas of the financial statements where the auditor wants to focus their attention. All right, and so we do that, by making sure that we follow the ASA. And so remember, all the ASAs related to audit evidence are in the 500s, but analytical procedures is ASA 520. 520. So that would be ASA and ISA for all my international viewers out there. So with ASA, ISA 520, it says we need to do analytical procedures at a number of different time points on the audit. We do analytical procedures at the beginning, so at the start, during the audit to help us collect evidence, and then at the end. And today what I'm going to focus on is how do we use analytical procedures at the start to help us identify these inherent risks or potential areas where we want to focus our attention. So let's look at an example. So I've got this activity here, and remember with analytical procedures we can do a number of different things. We've got ratios here, but you could also compare percentage changes in individual amounts. We've got our ratio, the actual for the company, the budget, the prior year, and the industry. And what we're doing is we're looking for things that are unusual, things that look out of place, which means for the auditor, so for us to be able to identify what's really unusual, it's really critical that we can understand the client. All right. So ISA, ASA 315 says really understand that particular client. So let's get into this particular example. And I'm going to zoom in a little bit so that we can see this. All right. So let's zoom. Here we go. So we're auditing a distributor of children's and clothing footwear, and they're in a low margin environment. So low margin means that we're interested specifically in people who are selling high volumes for low cost per individual item. Okay, high volumes are required to cover our overheads. Think back to our management accounting and our break-even analysis. And there's also some gearing, and they want to make sure that they remain solvent during the financial period. They did not meet industry benchmarks for profitability in the prior year. They're budgeting to do better. So they want to keep costs down in relation to sales while allowing gross margin to drop and generate larger volume sales. All right. So in terms of keeping costs down, they probably want to try and keep the cost of inventory down. So let's look at what we actually have to do here. So if we scroll, the little exercise asks us 3 ratios account balances that are at greater risk of misstatement and would require more detailed investigation. All right, so we would have a more substantive approach here in that particular situation. So we're going to take a substantive approach to auditing these particular areas because they have a higher level of detection risk. All right, so these would have higher DR. All right, so we need to be able to look at the ratios, identify the accounts, and then talk about the company's profitability, liquidity, and solvency. So let's scroll back up here, and I'm going to look at these line by line, all right, and then we can go in and we can look at the actual responses of what we should do. So I normally recommend when we're doing analytical procedures to take a line by line approach. So let's look at each line one by one and see if anything pops out at us. All right, so our current ratio has gone from 1.4 up from 1.3, but a little lower than industry average. So if we're thinking about this just on the surface of things, that doesn't look too bad. All right, so I'm going to put a little green tick. I'm going to put a tick there just for that individual item. Okay, now let's look at the quick ratio. Whoops, got the wrong tool on there. So if we look at the quick ratio, prior year is 0.79, industry is 1, and we've had a slight improvement, all right? But still not as good as the industry. So with our quick ratio, I'm a little less enthused. So I'm just going to put little stroke there, sort of just average, so-so. I'm reserving my judgment for now. So now let's look at the interest coverage. Industry is 6.2. So this is how many times our interest will be covered by our profit. So this is also sometimes called times interest earned. So this times interest earned is also sometimes what the interest coverage ratio could be called. Okay, so if we look at that, what we can see is that it has decreased. So that typically means that we have either less profit or more interest. And they were budgeting for more. So something here definitely is a little bit suspicious. All right, so I'm going to put a little question mark on that one. It's not a very good question mark. Let me try again. There we go. Okay, next one, debt to equity ratio. Industry 0.4, so this is the amount of debt to the amount of equity. So 0.55, they were budgeting for less. So something has happened that has meant that they're having more debt or they've reduced their equity. So it's definitely something to be concerned about here. I'm going to put a little red dot to let us know that's something to be concerned about. Inventory turnover. Now, inventory turnover has gone from 11 down to 10. Industry is quite high, and they're also a little bit lower on their budget. So this means that they're actually slower at turning over their inventory. So inventory is being held for longer. That's definitely something there that is going to be of concern. So I'm going to put a little red dot next to this one. Accounts receivable turnover is also down. From 7.4 to 6, it means we're slower at collecting our money. So definitely something going on there. Gross margin has dropped a little bit from 9.6 to 7.7. They said it was going to drop a bit, but this seems quite a lot. Remember, gross margin is gross profit as a percentage of our sales. And realistically, either sales and cost of goods sold should be moving in the same ratio, so something at the same percentage. So something is not quite right there. Definitely something I want to investigate. Admin expense, slight decrease, but if we go back up here, remember it said that they want to, keep costs down. They want to, overheads need to be under control. Keep costs down in relation to sales. So this seems pretty standard based on what the company has been talking about. So I'm not really concerned about that. Return on equity is increased, which is unusual. Return on assets is increased. So maybe somehow they're making a bit more profit. And the allowance for bad debts has gone down. That's the provision. So remember, our allowance for doubtful debts is a contra asset. Okay. So we've looked at individual items here. Let's look at those items in comparison to everything else. I'm going to do some highlights in some different colours here. Okay, so let's go through these one by one, and I'm going to just move this over here so that we've got a bit of room to write on the side. But first off, the first one I'm going to be really concerned about, and the question asked us to identify 3 issues, but I'm going to start with this one, my inventory turnover. Oops, let's make that highlighter a bit bigger. That's thicker. So inventory turnover is definitely down compared to everything else. So the account that I'm really interested in here is definitely going to be my inventory account. And in regards to whether I'm worried about overstatement or understatement, inventory is moving slower. So I'm worried about potentially obsolete inventory. Do we have inventory that we can't sell that we need to get rid of? So that's going to be the valuation assertion there. Oops, what did I do? A little extra space. So I've got my inventory valuation. Let's shrink that down so I've got a bit more room. All right, because it's definitely decreased. I'm worried about that obsolete inventory. Now the next thing that I'm going to be concerned about is going to be accounts receivable. Now, why might I be worried about accounts receivable? Because it's gone from 7.4 right down to 6. Let me fix that highlighted line. Okay, so that means that it's taking longer to collect money. So because it's taking longer, taking longer to collect my dollars. All right. And because it is taking longer to collect money, that means that the ratio is going to be down. Now, in terms of what account, it's going to be related to my provision for doubtful debts. And if we think back to before, well, that's actually going to be related to my contra asset. Okay, so remember our contra asset down here. Whoops, that line's a bit thick. So when it's taking longer to receive money, then either people are taking longer to pay or they're not paying at all. So that means that this number here actually should be going up. But in reality, it's gone from 1,600 the previous year down to 1,280 when it should be increasing. So that provision for doubtful debts, I'm definitely going to investigate there. Okay, let's look for something else. We've got our times interest earned. Let's go up here. So it's taking, well, we're using more of our profit to actually pay back our loans, to pay back our interest on our loans. So that could be one of a couple of different things, and you've got a couple of different options here. You've either got increased debt and interest expense, or lower profit. So we don't know which one of those it is. Could be both, could be one. But definitely when it comes to what accounts we're going to investigate, then we're definitely going to look at our liabilities. So long-term liabilities, okay, and we're going to be looking at profit as part of the audit, but with our long-term liabilities, I really want to make sure that I've got all of them and that they're valued correctly. All right, let's just shrink that down a bit so I've got a bit more room. Okay, so I've looked at my interest coverage ratio. I've looked at I've looked at inventory turnover. So I've done this one. I've done inventory turnover, accounts receivable. My gross margin doesn't really tell me what account is unusual, but it does tell me I might need to think about sales and cost of goods sold, which we're sort of looking at a bit through the inventory and a bit through my accounts receivable. The other thing, probably the last one I want to mention here, what colour will I do this? Let's do this in the red highlighter. I need to make my pen a bit smaller here to fit it in, is going to be my debt to equity ratio. So you can see here that it's definitely increased from the previous year, which makes sense with this here. So we're definitely going to keep looking into our long-term liabilities, and so our accounts are going to be the same sort of accounts there, our liabilities, because it's unlikely that the company has got enough cash to engage in a situation where they might actually try and decrease equity. All right, so they're more likely to be increasing our debt. So, where are we at for the entire task? We've got some ratios that are greater risk of misstatement. We identified the accounts and the assertions. Oh, for the provision for doubtful debts, that's going to be our valuation and existence assertions there. So let me add that in. Valuation, existence, because we're worried that some people may not actually be in there at all as, let me change the colour of that. I don't want you to be green. I want you to be purple. All right, let me shrink that down. Okay. All right, what did the rest of the question ask us to do? It asks us to think about profitability, liquidity, and solvency. So, if we think about that, current ratio has actually gone up, and the quick ratio, but I think that while we thought that was a good thing at the beginning, it may not be such a good thing now. All right, because I think those issues might be driven by this slow-moving inventory. So it's being pushed up by inventory, not really by making more sales or having more cash. So in terms of profitability, company's still profitable, but realistically, my gross margin isn't great. So I'd want to definitely look at all my other expenses. Liquidity, I'm a bit concerned, especially because this is below 1. We usually want our quick ratio below 1. And our current ratio seems to be increasing, driven by inventory and potentially more accounts receivable, which may not actually be collectible. And then solvency, well, here we're looking at a whole lot of ratios that are based around accruals. What I want to do, and I'm going to scroll down a bit here to make some more room, is that I want to make sure that in this particular section or this particular task, I want to actually look at the cash flow statements. All right, because the cash flow statements will tell me exactly what is going on in regards to liquidity and solvency. Now, specifically out of those cash flow statements, I'm going to want to look at one particular part, and that's going to be my operating cash flow. So if the company is making sufficient cash from operating activities, then I'm going to feel a lot better about their liquidity and solvency. However, if most of the cash instead is coming from financing, which in this instance is probably going to be more debt, then I am going to be a lot more concerned. And I'd want to look closely at any of our accounts related to our debt covenants. Now, certainly in this situation, where if more money is coming from the financing side, I'm also going to be a lot more concerned at the end of the audit because I'm going to be worried about the issue of going concern. Okay, and going concern is this idea of, well, what happens if the company can't continue over the next 12 months? So there you have it, my brief little overview of how we might go about doing some analytical procedures based on some ratios that have been calculated. Remember, we go line by line, and then we look at how all of our different ratios interact and might fit together. Thanks everyone for watching. If you like this video, make sure you give us a like. For more videos on auditing, check out our channel and the various playlists. Please make sure you subscribe to keep up to date with all the latest auditing news here and on all my other social media accounts. Amanda Loves to Audit on Facebook and Amanda's Audit on Twitter. And I'll see you all next time.